rent expense down here. We stopped paying rent 3 months ago. Why is there a rent expense? You can say, oh, I got a check. But if you don't have that objective evidence, you can't prove why you did that transaction. And now your accountability as an accountant is called into question because you're accounting for things that you don't have proof for. So the whole thing about objectivity is you need proof to be able to put things into your journal, to be able to account for things. You are an accountant, okay? You are accountable, so you need proof. And again, we talked about keeping that for 6 to 7 years. I think it's 6 years now for audit purposes. Okay? Business entity. Materiality, I'm going to do last. The matching principle. This is one of the harder principles. What the matching principle says is you need to match revenues and expenses together. Now, there are two other GAAPS that are embedded in this principle, the revenue recognition principle and the expense recognition principle. The revenue recognition principle says we record, we put it in our journal and our T accounts, revenue, when we earn money. When we do a job, when we sell a good, that's when we say we earned or we made money. Expenses, when we use something up or when we lose money, that is an expense. And the expense occurs when you use it or when you lose it. The problem is I can gain revenue this year and it makes my net income look good. Expenses make my net income look bad. Okay? So what I want to happen is, if I make revenue, I have to spend money to make money, right? You got to spend money to make money. If I'm building a deck, I got to spend money to buy lumber. I build the deck, I pay some employees, I spend more money there, and then someone gives me money for building a deck. So I had to spend money to make money, right? Those all affect spending money, losing money, and gaining money affect my income statement, or my profit, okay? If I build a deck, my revenues, the money I earn, should not be on a different income statement than all the money that I spend. Does that make sense? I can't say, oh, we made revenue for the deck this year, and I spent all my money for the deck this year. Those are two different income statements, one for one year, one for the other. They need to be on the same income statement. So when I have a revenue and when I have an expense, the matching principle basically trumps those two recognitions, revenue recognition and expense recognition, and says you have to put them into the same fiscal period if they are not. So yes, we recognize revenue when we make the money. Yes, we recognize expenses when we spend it or lose it, when we spend money or lose something. But if those two are to be together, on this, if they're for the same job and we don't put them into the same period, then we have to get the money and make the money and spend the money in the same period, then we have to put them into the same period. We have to disregard the revenue recognition principle and the expense recognition principle, and we have to follow the matching principle and put them together on the same net income. Okay? So if I get revenue for painting a room and I paint the room today, all right, and my fiscal period ends tomorrow, all right, and then I go out and I have some photocopying expenses to bill my customer and things like that the next day, that's in a new year. I've got to bring those expenses back one day to match with the revenue that it helped earn. Okay? It's a tough one. We're going to talk about matching principle a lot more in this class. Okay? When in doubt, answer matching. When I ask you what gap is being violated, usually it's the matching principle. Okay? Conservatism. Conservatism says when you as an accountant need to make estimates, you have to err on the side of caution. You have to make the estimate that's going to make your net income look lower. Okay, that means making revenue estimates that are lower and making expense estimates that are higher. Okay, because that makes your net income low. You don't want to estimate and say, oh, our net income is going to be $1 million, and then it turns out not to be lower than that. You'd rather say, oh, our net income is going to be $1 million, and it turns out to be higher than that. So when you make estimates, you estimate on the low side of net income. How does this come into play? When you're buying land or when you're buying a building and they're lumped together and you have to get them appraised, and to put a book value onto them, to put them into your books. Someone might say the land is worth $1 million. Someone might say it's worth $1.5 million. In that case, you're going to say, okay, my land is worth $1 million because I'm erring on the side of caution. If I choose $1.5 million and it's really worth $1 million, then I go, oh no, my asset I thought was worth $1.5 million. That sucks. It's really only worth $1 million. But if I estimate it at $1 million and later find out it actually is $1.5 million, that's a good thing, right? So I'm going to err on the side of caution. That makes me look better if I'm mistaken. Does that make sense?
Yeah.
Okay. So anytime I need to make an estimate, how much of my house am I using as office? Well, I'm using one room. How much of my house? 10%, 8%, 5%, 15%? It depends on how big my house is. I'm using 1 room out of 20. Then I should take 5% or less, because that is conservative. Okay, even if it's the smallest room in my house, and I'm using 1 out of 20. Okay, does that make sense? Full disclosure. Anything that is important to investors, management, or any other what we call stakeholders in the company needs to be put into the financial statements. What are the financial statements? Most importantly for you guys, they are your income statement and balance sheet. Okay? The journal doesn't get shown as a statement to the public. T accounts, the ledger, doesn't get shown as a statement to the public. The public generally sees your income statement and your balance sheet. You send those out to the public. If you're being sued for an exorbitant amount of money, that's important for people that are reading your statements to know. You might have to pay $1 million next year. You would include that in your statements. Okay? If your owners are considering, selling their shares, well, in a corporation, if your owners are considering selling the company to someone else next year, you might want to include that in the financial statements because that's important information. If you have a contract with a company that represents 95% of your revenue, and that company has said we no longer want to do business with you next year, then you might want to include that in your financial statement, saying, listen, our revenues for this year were $10 million, but the company that gives us 95% of that $10 million, they told us they're not going to use us next year anymore. That's important information for investors that they should know about. Okay? So that's the full disclosure principle. All right? And the final one that we did in class, again, I'm going to do more on the board later on, but the final one that we did in class was the materiality principle. Okay? So this is oftentimes the most difficult for students to understand. And so what I use is the, what's it called? I used to call it notwithstanding, but it's not notwithstanding. History. In the Charter of Rights and Freedoms, the government has an overriding clause. Does anyone know what that's called? That they can use at any time? Is it the notwithstanding clause? Are you sure?
Yeah, I take a look.
Okay. So it says basically all of your rights can be taken away if we deem that there is some other more important issue or right that we need to preserve, then we will use the notwithstanding clause. And I think Trudeau used it in Quebec at some point in time when he put a curfew on people, right? Okay, so my history, the last time I took a history class was grade 10, so I'm sorry if this information is incorrect, but you guys know what I'm talking about, right? This is the materiality principle. The materiality principle says I can override any GAAP I want. I cannot follow these principles if it is too timely, or if it is too time-consuming or too costly to follow the GAAP. What does that mean? If it's going to cost me too much time and effort, or if it's going to cost me too much money, then I am going to ignore the GAAP. So one of the GAAPS says that expense recognition. Okay, you spent $100. Your accountant put $105 into the books by accident. So at the end of the year, your debits and credits are off by $5. You're Walmart.